Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and today we are going to start the pre-mock for December 25 attempt, and we are going to discuss MCQs. Definitely, the objective is the motivation because I've already uploaded so many classes that I think students can't watch complete, right? So again, it's for your motivation, and one more motivation for you guys are admin team has compiled some positions, it's not complete, of F7. Yes, for SBR it's different, for TX I also teach TX, I also teach FA, it's different. So the total number is around 150 plus something just from me, my position holders. So you can see in this section, you can see the world top as well. See this is also a world top. So these positions are for your motivation. They also studied the same lectures, they also followed the same guidance, and they proved themselves. So hope to find you guys in this list soon. Without wasting any time, let's start. See, this is the question number one, and this is linked to IAS 36 CGU area. Remember, hope you remember CGU. A cash generating unit has the following carrying amounts in Blue Company's financial statements at 30th June X7 before allocation of impairment loss. So, this is basically the column of carrying value. This is basically the column of carrying value. Now, the next thing is the CG is found to be impaired by 1.13 million. They are ready made giving you the total impairment. They are ready made giving you total impairment. In reality, in past, when you were doing your exam kit questions or the other questions, you had to calculate total impairment loss yourself. But right now, they have given you ready made. Okay. So now what to do? First of all, definitely there is no obvious impairment, nothing a thing about obvious impairment, so you will write off goodwill. You will simply write off goodwill. Let me do this for you guys. Okay, so the total impairment is 1130 1.13 okay, this is your total impairment. So, and this is the column of impairment. Now, first of all, you will write off the goodwill. You will write off complete goodwill. So this is 550,000, and this you will get nil here. Okay. So out of total impairment 1130,000, how much to be allocated to goodwill? Goodwill is 550,000. Okay. So the remaining impairment is 580. Now the remaining impairment to be allocated between remaining assets. Okay, but first of all, on this date, some more information. On this date, the plant had a fair value less cost of disposal of 1 million. Listen, so right now the plant is at 950. Plant is at 950, but fair value less cost to sell is 1 million. So now whatever will be the value in use, don't worry about it. The fair value less cost to sell is 1 million. 1 million means 1 0 0 0 0 0, 6 zeros. So that means if you compare plant, there is no impairment. Plant will still stay at 950,000. Yes, because when nothing is written, it's a cost model. Okay, so you have already checked plant separately. The carrying value is 950, whereas the fair value less cost to sell is 1 million. So definitely no impairment should be allocated to plant. Now one more thing, net current asset, you have already taken the lecture. No impairments to be allocated to net current asset. Normally in net current asset you have cash. So if you have cash of 430,000 in your pocket, the value of that cash is same. The value of that cash is same. So same 430,000 will come here. Now two assets are left. One is building and the other one is intangible asset. One is building and the other one is intangible asset. Now the remaining impairment of 580,000 is to be allocated between these two. So let's do it. 1300 plus 400 is 1700. So what will be the fraction? What will be the fraction for plant? Sorry, building. For building it will be 1300 divided by 1300 plus 400 into remaining impairment is 580,000. Okay, so let's calculate for building. It's going to be 443529. 443529. And if you want to calculate for intangible asset, you can. Yes, you can. How for intangible asset it will be 400 will come on the numerator, then 400 plus 1300 multiply by 580,000. So it will be 136471. 136471. Okay, although in this question for intangible asset you are not required to do. I have said this many times in my classes that in MCQs or MTQs never do any extra work, never do. So 136471. So let's calculate the final value. So goodwill is 0, plant will come as it is. Now 1300,000 minus 443529 is 856471. This will be 856. Wait. So 856, and then you have 471. Okay, now if you read the requirement, you don't need to do complete question. No need to solve for intangible asset anymore. No need to solve for intangible asset anymore, right? Okay, so it will be, what is the carrying amount of the building following the recognition of impairment loss? This is 856471. 856471. And guys, you have done similar questions in the class as well, right? Okay, so the next question is, the IASB conceptual framework for financial reporting defines recognition as the process of incorporating within the financial statement an item which meets the definition of an element satisfy certain criteria. Now, which of the following should not be recognized in the financial statement? Okay, very simple question. You can read all of them and then tell me which one is the answer. Wait, let's start with the last one. As equity, a right issue of shares. Yes, right issue is equity. This is correct. And right issue, for right issue we make the entry bank debit, ordinary share capital credit and share premium, so it's an equity. Yes, so this is true. We need to figure out not the wrong one. As an asset, the present value of cost of, yes, for sure, this is also correct. Why? Because in case of compulsory disposal cost or decommissioning liability, you calculate the present value, and for that present value you make the entry property, plant and equipment debit and provision credit. So yes, we record that asset at present value. That's correct. Now, as income, goods delivered to customers for which payments is still pending, the customer is responsible. Yes, this is also income. Credit sale, this is credit sales. Yes, for sure, credit sale is also sale, and we book the income, receivable debit and sales credit. No matter we haven't received the money, but still it's an income. But now, as a liability, a provision for operating losses expected in next 12 months. This is the correct answer. Why? If you remember IS 37, in IS 37 you clearly studied this concept that no provision is made for future operating losses. Even I gave you the reason at that time as well. Why no provision, no liability? Because there is no present obligation. And yes, these losses can be avoided. How? If you close the business before that date, then there will be no losses. So You cannot book liability for future operating losses. This thing you have studied in IAS 37. So correct answer is A. Correct answer is A. Next one, a very routine concept, a very routine concept you have done before. This is from IAS 40. And remember, we did one topic which we called change in use. Change in use means there was a property previously, it was classified under IAS 40. Now we are jumping from IAS 40 to IAS 16. I'm just telling you the case. Okay, so brake company owns land that was purchased on 1st January X2. Keep this date in your mind. For 2 million, this is the cost. The company initially held the land for capital appreciation. Okay, so no other use, you are not using it, it is only for capital appreciation. So yes, it's already in IS 40 right now. This is in IS 40, it's in IS 40. Okay, now on 1st July X4, mid of the year, brake company occupied the land and began construction of its new head office. Okay, so now we are using it for the purpose of head office. So it's IS 16 now. So it's a jump, basically a change in use from IAS 16 to IAS 40. Okay, sorry, IS 40 to IS 16, sorry. At that date, the fair value of the land was 2.5 million. Keep this fair value in your mind. Now, whenever there is a case of change in use, I hope you remember my classes. I just said one thing. Just see the model of IS 40. Which model is to be used for IS 40? Brake company uses the cost model for owner occupied, means for IS 16 they are using cost model. And the fair value, yes, decision making line, fair value model for investment property under IS 40. Okay, very simple. Now let's do it. So this is your 1st of January X2. You bought the land for 2 million. Okay, this is 31st of December X2, and this is going to be the mid of the year, 1st of July X2. Okay, so this is the area of IS 40. First of all, in IS 40 you are using fair value model. So as we know, in land we never do depreciation. Even if you are using cost model, or even in IS 16 there is no depreciation for land, so forget about it. But if you are using fair value model, then what are the rules? And this is the date of change in use. This is the date of change in use. At the date of change in use, you need to bring the asset to fair value using the previous model. So fair value is 2.5. So what you will do, first you will use IS 40. So you'll make the entry investment property debit 0.5 and PNL credit 0.5. Okay, now already you bought the asset for 2 million, and now you increase it to by 5.5. So it's 2.5 million. Now you'll make the entry for change in use, and the entry will be PPE debit 2.5 and investment property credit 2.5. From now onwards you will be using IS 16 cost model, and it will go as it is. Okay, so this is the whole story of this question. So the answer is, how should brake company account for the change in use of land on 1st July X4? Transfer the land from investment property to PPE and recognize a gain of 0.5 million in the investing category. You remember IFRS 18. the latest IFRS 18. As don't forget this thing, very important. In IFRS 18, investment property gains and loss goes in the investment section. Goes in the investment section after operating profit. Okay, see in this, so this is perfect. A is correct. A is correct. Now if you want to see, read the remaining, all the remaining they are incorrect. Transfer the land from investment property to and no, not at carrying amount, you need to bring it to fair value because you are using fair value model. Third, transfer the land from property, plant and equipment to invest. No, this should be from IS 40 to IS 16, not 16 to 40. C is absolutely wrong. Continue to measure the land under 2 million without a no. We need to change it. So the first one is correct. First one is correct. And I am sure you guys can do it yourself as well. This is not difficult area. Next, on 1st of January X4, Ponder Company entered into a lease agreement. IFRS 16 is here. To lease an item of machinery for 4 years. Okay, this is the lease term. With rentals of 250,000 payable annually starting on the last date. That means every year you need to pay in arrears. Every year you need to pay on the last day. There is no advance rentals. The asset has a useful life of 5 years. Now this is the question. Lease term is only 4 years, life is 5 years. Recall your classes. Lease term is 4, life is 5 years. And now the changing line, now the decision making line. At the end of the lease term, legal ownership will pass to Ponder Company. So what will happen? Legal ownership means the asset will come to you. That means first 4 years we will be using as a lease term, and last year the asset will be shifted to lessee. Hope you remember the case. Let me call the name of this case. If the asset is expected to be transferred to lessee, at the end of lease, then in that case you need to depreciate it over the life. Why? When in the end asset will come to lessee, so that means lessee will use throughout the life. So the life is king. Life is everything now. So we'll depreciate it on life. Okay. That means the present value of the lease payment at the inception of the lease was 750,000 and the interest rate is 12.2%. Now wait. First of all, you'll make the entry initially. ROU debit and lease obligation credit 750,000. Okay. Then you will make the column date. Hope you remember this. Rentals, finance charge, decrease and balance. Okay. So no need to make such columns. I'm just recalling you the classes. So your initial balance is 750,000. Okay. And now as the first payment will be made on the last day, first rental will be made on the last day of first accounting period. That means throughout the first accounting period, the outstanding amount was this. And we always apply interest rate on the outstanding amount. So 750,000 multiplied by 12.2%. 750,000 multiplied by 12.2%. 750,000 multiplied by 12.2%. So it will be 91,500. This will be 91,500 is your finance cost or interest expense. Now as a student you may ask one question, sir, why you are not solving complete schedule? Because it is not needed. You can see the requirement. So yes, we have calculated the interest expense, the finance cost. The second thing, they are asking the total expense. So there is one more thing which we call depreciation expense. Now I have already explained you that depreciation will be done over the life this time, not lease term, because in the end asset will be transferred to lessee. So 750,000 is the asset cost, divided by 5 years, it's going to be 150,000. So this is the depreciation. So 150,000 is the depreciation, and 91,500 is your finance cost. These two are your expenses. These two are your expenses. So if you add these two, it will be, I think, 241,500. It will be 241,500. Take your time. Take your time. Take your time. Please check the question. Take your time. Nothing else is required in the question. So as my rule and instruction, you have less time in the exam. Just do what examiner is asking. No extra work at all. No extra work at all. Okay, next. This is very easy. IFRS 9. IFRS 9, fair value through OCI equity. Fair value through OCI equity. Okay. Reagan Company purchased 10,000 shares on 1st September X4, making the election, yes, election to measure the item, at the fair value through OCI. Okay, the category is fair value through OCI in accordance with IFRS 9. The shares cost 7.65. Now wait. Initially you bought it on 1st September. So 10,000 multiplied by 7.65. 10,000 into 7.65. This will be 76500. This is your cost. So the first entry you guys will be making is investment debit and cash credit. 76,500. Investment debit 76,500 and cash credit 76,500. Investment debit and 76,500 cash credit. Now, as you all know, in this category, fair value through OCI, if there is any transaction cost, yes, transaction cost will also be capitalized. Transaction cost will also be capitalized. So yes, transaction cost is 1,500. So again you'll make the entry investment debit 1,500 and cash credit 1,500. So at the day one the value of your investment will be these two. Okay, 76,500 plus 1,500 is 78,000. So initially your investment is recorded at 78,000 including the transaction cost. Now what will happen at the year end? At the year end, it is the requirement to bring your investment to fair value. So what is the fair value at the year end? The fair value is 8.5 per share. At the year end, the fair value is 8.5 per share. Okay. So how many shares are there? 10,000, $8.5 multiplied by 10,000. It's going to be 85,000 is the fair value. Fair value is 85,000. Now, already the investment is recorded at 78,000 initially. Initially it is 78 and at the year end the value is how much? 85. So from 78 to 85. From 78 to 85, how much is the change? The change is only 7,000. So at the year end this entry will be made. Investment debit 7,000 and OCI credit 7,000. Investment debit 7,000 and OCI credit 7,000. Okay. Now, what amount should be recognized in other comprehensive income in relation to these shares? Yes, the answer is this gain will go in the OCI. This gain will go in the OCI. That's it. Okay, which two of the following? Now this is your preparation, I'm telling you, for MCQs, these MCQs are dangerous MCQs. Which of the following criticism, they are not asking you for the advantages. They are not asking, you don't need to pick the advantage of this accounting, you have to pick the criticism. And also you don't have to pick the false statement, only criticism you have to pick. Which two of the following criticism apply to current cost accounting during a period of inflation? Just think about current cost accounting means you need to bring it to fair value, means you need to revalue it, you need to revalue your asset, simple, go easy. So what is the disadvantage of revaluing your asset? What is the criticism? Whenever you revalue your asset, what are the criticism you face? Number one, it requires frequent revaluation of asset, which can be subjective and complex. Yes, for sure. If you are using revaluation model and inflation is going on, so because of inflation, price level will change. Because of inflation, price level will change. And whenever price level will change, you have to do revaluation. And whenever you do revaluation, so revaluation requires judgment, because my eyes are different, your eyes are different, the third guy, you need to do some subjective factors, you need to include subjective factors for revaluation, for calculating fair value. Okay, so it requires subjectivity, complexity. Yes, it's difficult process. In my class I have given the lectures as well, that revaluation is cost consuming as well. You need to incur cost for revaluing big properties. You need to bring experts as well. An ordinary person cannot calculate the fair value. Okay, so yes, this is a true criticism on current cost accounting. It may reduce comparability between companies using different valuation methods. Yes, if you are using current cost and the other guy is using the historical cost, so comparability issues. Same properties, we bought two same properties for $1 million 10 years ago, but now the fair value is $10 million. But if this guy is using cost model and this guy is using revaluation model, so definitely there will be issues of comparability for sure. So it's a true criticism. So these two are correct. Now these two are the real answer. Now let's read the third one. It reflects prices of assets prevailing at the time of yes, this is the advantage. This is the advantage, though not criticism. This is the advantage. If you are using revaluation model, then your shareholder can see the real market prices. So it's an advantage, not a criticism. So we need to pick the criticism. Okay, so this is not the answer. It is less useful for decision making than, no, this is wrong statement. This is pure wrong statement. In reality, it is more useful for decision making, because now the shareholder can see the real value of the company. So this last statement is absolutely wrong statement. So we had to pick only the criticism, and the first two items are perfect criticism. Hope you understood it. Think over it. Now, on 1st of April X7, Chimpy company delivered a machine to a customer. This is basically IFRS 15. Okay, IFRS 15. The machine was priced at 260,000. The customer had a right to return the machine for a full refund at any time up to and including to 30th June X7. Now wait. When we were doing IFRS 15 in the class, we came to the stage 3. Stage 3, remember the price. And you know there are two types of prices, fixed price and the variable revenue. Fixed price contract and variable revenue. In variable revenue, I gave you the example of penalty clause. I gave you the example of incentive clause in construction. Then we discussed the example of, sale or return basis. Remember, when you give pure right to return to customer, again you are uncertain that if customer just press one button and everything will be returned. So again, this is a variable revenue, and you know, variable revenue can only be booked. Variable revenue, listen my words, can only be booked if the reversal is highly improbable. If the reversal is highly improbable, let's see, if this is written, then it's okay. If it is written that the customer will not return at all, if it is written that it is highly probable that customer will not return at all, then perfect, then we'll book revenue. See, this is a new customer. So again, when there is a new, this is a new customer, we don't know the history, we cannot even predict now, and at 1st April X7, Chimpy company was unsure whether they were likely to return the machine on or before. So they are not sure. So when they are not sure that customer will not return this machine, so again there is a risk. So in that case, you cannot book the revenue, you cannot book the variable revenue. So what entry you will make? You will make the entry, you cannot make the entry receivable debit revenue credit, not at all. You cannot book, you have not fulfilled the condition of revenue booking. You have not fulfilled the condition of revenue booking. But still, listen, at one end you are asking money from him, so receivable is there but no revenue. On the other hand, if he comes and asks money from you, so you need to refund. So we'll be making the entry receivable debit and refund liability, receivable debit and refund liability credit, receivable debit and refund liability credit. And you know, we have only delivered the machine to this guy, only delivered. Okay, so we'll make the entry receivable debit and refund liability credit. Now, as a student, one thing may come in your mind, that what if later on, after a few months, listen, we have not received any cash, that's why we book the receivable. We have not received any cash, that's why we book the receivable. And on the other hand, definitely he can ask for the refund, that's why we book the liability. That's why we booked the liability for refund, because you can't book the revenue. Whenever you can't book the revenue, it's like a deferred income or something. Now, later on, if you are sure that customer won't ask the refund, at any point you are sure that customer won't ask the refund, that it is highly probable that now things won't get reversed, so what you will do, you will cancel this liability, you will debit this liability, and you will book revenue credit. Liability debit, revenue credit, liability debit and revenue credit, then it will be your income. Just for your clarification, I am telling you this. Now you have IAS 21 with you now. Next is IAS 21, and you did the monetary non-monetary thing many times, monetary non-monetary things many times. At 30th November X3, V company purchased land in another country, definitely in other currency, at a cost of 45 million euros. Now the land was classified as property, plant and equipment, measured using this is important line, using cost model. At V company's year end of 31st December X3, it had paid, now that means this payment has been done, so unpaid amount is 9 million. Unpaid amount is 9 million. Unpaid amount, this is the liability at the year end. Unpaid amount is 9 million euros. Okay, now what they have given you the exchange rate at 30th November X3 at year end, and this is the average rate, which is not useful, leave it. Now what is the carrying amount of land and payable at 31st December X3? Now wait, go very slow and think over it. First of all, there are two things, one asset and one liability. The asset name is land. For sure, land is property, plant and equipment, and land is a non-monetary asset. Land is a non-monetary asset and we are using cost model. Land is a non-monetary asset and we are using cost model. So for non-monetary asset, we just do one thing, just one thing. At the date of purchase, the date when we get the control, we simply translate into our currency and then we'll never touch it. We'll never touch it. Okay. So just use this rate. Use this rate. 3 euros to $1, 3 euros to $1 at 30th November. Sorry, the date is yes. At 30th November X3. Okay. So 45 million euros was the cost divided by 3. Why divided by 3? Because 3 euros is equal to $1. So 3 to 1. We are shifting from 3 to 1. So we are shifting from a bigger number to smaller number. So we need to divide. So it's going to be $15 million. Okay. This is the cost of land. Cost of land. Okay. So land will be recorded at this cost. Land will be recorded at this cost, and as we are using cost model, no need to touch it in future. So at the year end, that is 31st of December X3, it will remain at $15 million. It will remain at $15 million. This is a non-monetary asset. Please read the book or take the class. But now the liability is a monetary item. Liability. So how much what they are, first read the requirement. The best thing is read the requirement. What is the carrying amount of land? Yes, I have done it. And the payable, how much is the payable amount? Only 9 million euros. 9 million euros is your liability. At which date? 31st December X3. Now I'm not doing everything now because as you see, the requirement just in MCQs. Just see the requirement and save your time. So obviously out of 45 million euros we have paid 36 million euros and we are not doing accounting for that. Only the unpaid amount, the liability is 9 million euros. And yes, liability is a monetary item. Why? Because liability means amount to be paid in fixed and determinable amount of money. So it's a monetary item. And yes, monetary items are recorded at the year-end exchange rate. So year-end exchange rate is 2 euros to $1. So how to calculate the 9 million euro liability? 9 divided by 2, $4.5 million is your payable. The value of your payable at 31st December X3 is 4.5. So answer is A. Answer is A. Take your time to think. Yes, you have taken classes. These are revision days. These are pre-mock exam classes. Okay. Next is related to IFRS 5 non-current assets held for sale. But before we move on, let me clarify you the straight away condition. For held for sale, there is one very strict condition. The asset must be available for sale in its immediate current condition. It must be available for sale. Current condition. So in this example I have used in the class. For example, I have a machine that automatically produces markers. But at the year end, I have taken orders for 5 million markers from my customer. And this machine will be used in the production of markers. So now it's not held for sale. Now it is not held for sale at all. Now let's start. On 1st November X5, Jame's company held a factory with a carrying amount of 10 million, measured using the cost model. Perfect. The factory had a remaining useful life of 10 years. Again, perfect. So this is the normal remaining life. And let me tell you the date. The date is 1st November X5. Carrying value is 10 million. and your year end, let me write the year end is going to be on 31st of October X6, exactly 1 year difference. See, exactly 1 year difference between these two dates. Now Jame's company intended to sell the factory, so only intention is not enough. You need to prove your intention as well. So as soon as the major customer order was completed, see, that means there is some outstanding order, there is some out, so right now there is, the work is going on. This was expected to take at least a year, so that means at the beginning of the year it was not held for sale. At the beginning of the year it was not held for sale. Now, Jame's company started marketing the property for sale on 1st of August X6 at a price of $14 million. At a price of $14 million, right? So they have started marketing, but again, marketing is not the only factor. Right now the factory is being used for the production, so it's not available for sale in its present condition. Which was the property's fair value? Okay, we are doing marketing in fair value, this is good thing. Okay, cost to sell is 0.5. Now at Jame's company's year end, now this is the point, let's see whether they have met the condition of held for sale at the year end or not. So at Jame's company's year end, the customer order was still incomplete, that's it, it's not held for sale, simple, not held. But it was expected that this would be completed at the end of November. See, your year end is here, they are saying that it is expected that it will be completed by November. So we have to take decision here. We have to take decision here. We need to take decision here at 31st October X6. The fair value of the factory at 30 was 14.4, irrelevant and irrelevant. Now, what is the correct carrying amount of the factory in Jame's company's financial statement at 31st October X6? Now tell me. Do you think at the year end of 31st October X6 is it held for sale? The answer is no. Why? Because the order is still not complete, that means the asset is not available for sale in its present condition. So if the auditor will visit the factory at 31st October X6, it's not held for sale. When it is not held for sale, no more IFRS 5. When no more IFRS 5, it's purely IAS 16. It's purely IAS 16. And yes, read the question carefully. In IAS 16, we are using cost model. So simply cost model depreciation. So this is the carrying value and the remaining life is 10 years. Remaining life here is 10 years. So just do 10 divided by 10. 10 divided by 10 is going to be 1 million depreciation. So your carrying value, or what we call NBV at the year end is 10 minus 1, 9 million. 9 million will be your carrying value at 31st October X6. Answer is A. Okay, so it happens sometime they give you a lot of irrelevant data. In the question. So now you can check the question. On 1st June X8, Expense Company owned a building with a carrying amount of 21.6 million. On this date, Expense Company sold the building to a finance company for 36 million, its fair value, and immediately entered into an agreement to lease it back for 20 years, lease it back for 20 years. Now, what to do with this transaction? Okay, so hope you remember this topic, very famous topic of IFRS 16. And in IFRS 16, there is a topic of sale and lease back. There is a topic of sale and lease back. Okay, so when you start this topic, there are two arrows. The first is the sale meets the criteria of IFRS 15 performance obligation satisfied, and the other one is sale does not meet the criteria. Just think over it, which case is this? Thanks to the examiner has written clearly, see, the transaction constitutes a sale in accordance with IFRS 15 revenue with customer contract. Okay, that means this is the case number one, the routine case, the most famous case. Okay, so in that case, what you do, let me recall you. You have sold a certain asset, you have sold certain portion of the asset, and again you lease back, means you have retained certain rights, certain percentage rights. Okay, so what you will do, you will still book ROU according to the rights retained, and you will book gain on disposal to the portion that is sold, to the portion, the percentage which is sold. Okay, so how to calculate ROU retained? You remember, hope you remember, ROU retained. It's going to be carrying value of asset. See, this is the carrying amount, which is 21.6, multiply by how much payment you are doing, present value of future payments. You are paying in terms of present value, you are paying 30, and what is the fair value of the asset? The fair value of asset is 36, and you sold it for fair value, right? This is a very routine case, it should be on your tips. So 21.6 into 30, 30 is the present value, 36 is the fair value. So ROU retained will be 18 million, right? Now the other thing will be all balancing numbers. Listen, what you will do, first of all, you expense company sold the building for 36 million. So how much cash you received? Cash is 36. Okay, the first thing. The second thing is ROU retained. Obviously you sold a certain portion and you retained the certain portion. So ROU retained is 18 million. Now the third thing, as you sold the machine, this is a genuine sale, the performance obligation, the sale constitutes, see, it is written, the transaction constitute a sale with IFRS 15. So that means the carrying value, the PPE or machine, whatever it's, that this is the carrying value, 21.6 you will credit. Then obviously you promised them to pay certain rentals every year. So the future, whenever you promise somebody to pay in future, you need to calculate the present value, and that present value is 30 million. So your financial liability, or you call it lease obligation, is 30 million. And the last thing, the balancing figure will be your gain on disposal. The balancing figure, can you calculate the balancing figure? This is going to be your gain on disposal. How much is it? It's 2.4 million. So answer is 2.4 million. What gain on disposal should expense company recorded in profit and loss in relation to sale and lease back of the building for the year ended 31st May 09. Okay, so the only thing which we need to calculate is ROU retained. Hope you remember it. It's revision class, I'm telling you. You have done this in your normal classes. So it's case number one. And in case number one, obviously you are receiving cash, you debit cash. Obviously you sold it and you lease back. So again, you have some right to use for certain years. So ROU retained, you need to calculate ROU retained. Let me write the formula for you. Carrying value of asset multiply by present value of lease obligation and divided by fair value of asset. Okay, this is the game. This very famous. and you credit the PPE because obviously you sold the asset, it's a genuine sale. You credit the liability, the lease obligation thing, lease obligation. Yes, you promise to pay future rentals for certain number of years, so present value is your liability. And then the gain on disposal to the rights transferred, up to the extent of rights transferred, the gain on disposal. Again, now you have IS 37. Very good. Farfield Company has sold washing machines. Farfield Company has sold washing machines with a 1 year standard warranty as part of its contract for sale for 6 years. Okay. In the year ended 31st, see, first of all, they have written the word standard warranty. Can you standard warranty? So, as the word is a standard warranty, that's why IS 37. And there is one more concept which we studied. I teach you this, you guys, in the class. That is extended warranty, and that extended warranty is basically IFRS 15. So standard warranty is IS 37. In the year ended 31st December X5, it sold 125,000 machines, and in the year ended 31st December X6, it sold 135,000 machines. So there are two machines. Okay, now on average 8% of machines sold in a year need to be repaid under warranty. At each reporting date, the repair department estimate that the average cost per repair in the coming year. At 31st December X5, the future repair cost was expected to be 50, and at 31st December X6, it's 58. There are two repairs cost. Next year the repair cost is changed. Okay. Which statement reflects the correct accounting treatment for Farfield Company's financial statement for the year ended 31st December X6? Now wait. Let me solve it in very simple way. This is 31st of December X5. This is 31st of December X6. Okay. Now for this year end, how many units were sold? 125,000 machines were sold. Here 125,000 machines were sold. And what is the expectation? 8%. 8% machines will come back. So 125,000 multiplied by 8% is 125,000 multiplied by 8% is 10,000 machines, and the repair cost, these are 10,000 machines, and in 2005 the repair cost was 50. So 10,000 into 50 is 500,000. So at this date your provision was 500,000. Okay, now let's calculate the provision at 31st December X6. Now the number of units sold, the number of machines sold are 135,000. You can see it clearly. So 135,000 machines sold multiplied by 8% is the average rate you will get return. So 135,000 multiplied by 10,800. 10,800, right? Right, 10,800. And what is the per unit repair cost now? It's going to be $58. 6,400. Now this is the closing. See, if you make a T account of provision, so your opening provision will be 500,000, and what is the closing provision is you required is 6,400. So this thing you have studied in your basic level, that increase in provision is your expense, the additional, right? Increase in provision. So how much is the increase in provision? Increase in provision is how much? 1,26400. Yes, this is your expense. This is going to be your expense, okay, for the year. 126,400, 126,400. Okay, now as a student you may ask one thing, sir, was there any payments, of claims, was there any claim payments? Nothing is written, so that's why I just simply book the increase. That's why I just simply book the increase in provision, whatever is given in the question. Take your time, take your time. Now read the requirement. Far field has a constructive obligation and should make a provision. No, it's not constructive, it's legal obligation. It's legal. You are giving warranty clearly. It's written warranty, so it's not constructive. Wrong. Farfield has a legal obligation, yes, and it should make a provision of, no, it's not 540. Closing provision is not 540, it's 624. Again, it's wrong. See, read the full statement. Read the full statement carefully. Okay. Then we have Farfield has a constructive obligation. No, it's not constructive obligation. First line is wrong. Farfield has a legal obligation. Yes, this is correct. And should recognize an expense in relation to the yes, 126,400 in the profit and loss. See, profit and loss is always for the year. So for the year movement is this. So be very careful in the exam. This is very good question. You need to pick the appropriate answer. You need to pick the appropriate answer. Now next is on 1st September X4, Moore Company sold an item of heavy plant to a customer for 460,000. This is IFRS 15. Always keep one thing in mind. Whenever you are going to receive any payments in future, 1 year or more than 1 year, then you need to discount it. Then you need to calculate it at present value. Okay, this is the basic rule which you have done from the beginning. The plant was delivered on the same day. Yes, you delivered the plant, but see, the customer paid a deposit of 50,000. Right now customer only paid 50,000. On delivery, Moore Company provided the customer with 2 years interest free, in nothing is interest free on the balance of the cost. An appropriate discount rate is 6%. Okay. What revenue should Moore Company recognize in the year ended 31st December X4? In the year ended 31st of December X4. Now wait. Go very slow. First of all, you sold it on 1st September. Immediately you receive how much cash? The deposit you receive is 50,000. The deposit you receive cash of 50,000. And the remaining amount you will receive after 2 years. After 2 years you will see the total amount was 460. Out of 460 you just got 50,000, and remaining 410,000 you will get after 2 years. Okay, so basic rule of accounting, basics. This is basics. Whatever payments you are going to receive for one or more than 1 year, 1 year or more, you need to discount it. You need to calculate present value for that. And for present value you need discount rate, and in this question discount rate is 6%. So let me calculate the present value of future cash flow. Wait, so it's going to be 410,000 divided by 1 plus 0.06 power 2. 1 plus 0.2 years, 1.06 power 2. Okay, So it will be 364,899. 364,899. Okay, so this is the present value. So what is the entry? Now let me make a very good entry for you. Entry will be, first of all, you receive cash. Cash is 50,000. Then there was a receivable, and all receivables and payables for more than 1 year or more you have to discount. Receivable is 364,899, and finally you will credit the sales with, add both of them. This is the real sale. 50 plus 364 is 414,899. 414,899. Okay, so this is your real sales. They are asking about your real sales. This is going to be your real sales. 414,899. 414,899, sorry, sales. Okay, so whatever cash you are receiving has the same value right now, but the other 410,000 you will get it after 2 years. So the present value is different. Now what will happen later on? Just as a student you may ask, what will happen later on? Now you need to unwind this receivable. And listen very carefully. Whenever you unwind a liability, you get interest expense, and whenever you unwind a receivable, you get interest income. Think over it, please think over it after the class. I repeat, whenever you unwind a liability, you get interest expense, and whenever you unwind a receivable, you get interest income. Okay. On 1st July, X8 Field Farm Company received a 90,000 grant from local government to support its expansion. So you just received the government grant. Normally the entry for receiving government grant is bank debit and deferred income credit. Bank debit and deferred income, this is the normal entry. Now we always see one thing: why did we receive? Where are we going to use this government grant? That is the real thing. See, the grant used to acquire a tractor, means fixed asset, costing 240,000 on 1st August X8. This date is important. The tractor has a useful life of 10 years. Okay, very easy. Now, first of all, never amortize grant from the date it is received. No, you need to amortize the grant from the date when it is being used. So we bought tractor on 1st August X8, and the depreciation of tractor is starting from 1st of August X8. And you know the matching of all this scenario is matching principle. You need to match income and expenses. So from the date you will be starting depreciation expense, the same date you will be starting amortization of grant, so that it will be matched. Okay, so now very simple. Although you received the grant on 1st July X8, but you bought the tractor, you used that grant on 1st August X8. So from this date you are getting economic benefit of that tractor. So August, September, October, November and December, this is your year end December. So that means this year you use the tractor for 5 months, so you will be depreciating the tractor for 5 months. Same in the case for the grant amortization. You will book amortization of grant for 5 months only. Now listen. The day one entry will be bank debit 90,000 and deferred income 90,000. Okay, now how to amortize? it will be amortized on with the same life as the asset, as this grant is related to this asset, as this grant is related to this asset. So the way this asset will be depreciated, in the same way this grant will be amortized. So 10 years, so it's going to be 9,000 per annum. But how many months we need to book now? How many months? Only 5 months. So 9,000 into 5 upon 12, 9,000 into 5 upon 12 will give you 3750. 3750. Now use your brain. This 3750, the entry for this 3750 will be deferred income debit 3750 and P&L credit 3750. Now use your brain. So 90,000 was your initial liability, and how much it is amortized? 3750. 90,000 minus 3750 at the year end, your deferred income will be 86250. 86250. This is your year end. This is your year end deferred income. So you can pick multiple answers. First of all, keep this thing in mind. The real amortization of grant for this period is only 3750, which will go in the PNL. Which will go in the PNL. But what about the year end? The year end amount which will go in the SOFP as a deferred income liability is 86250. Okay. So now be careful while picking up the point. And yes, the value of asset, yes, one more thing, the value of asset is 240,000. Okay, the value of asset is 240,000, and asset will also be depreciated separately using the life of 10 years. Using the life of 10 years. Using the life of 10 years, right? Now let's pick the answer. Grant income of 90,000 is recognized. Never. Grant is deferred income initially, not PNL. Grant income of 4,500, not at all. The grant is presented as a liability with a carry. Yes, this is the correct answer. The tractor is presented as a property. No, tractor is 240,000 minus a little depreciation. Tractor is 240,000 minus a little depreciation, okay. So the answer is C. Answer is C. Okay, now the next question is related to IAS 38. Next question is linked to IAS 38. What they are saying: in the year ended 31st October X8, Mizzle Company incurred the following expenditure. Number 1, 330,000 to buy the rights to a soft drink formula on 1st January X8. The rights were determined to have an indefinite useful life. Okay, so it's an asset. So first intangible asset you will book. First intangible asset you will book for 330,000. Okay, and you, as the life is indefinite, no need to depreciate it. Okay, 12,000 to register its legal right to the formula on the day it was acquired. The right has no termination date. Okay, so registering a non-current asset is also a qualifying expenditure. Okay, you are protecting your non-current asset. Okay, so without this, your non-current asset, your intangible asset cannot be yours. So this is the legal requirement. And yes, hope you remember IS 16. Remember, legal cost to acquire an asset is always capitalized. Now 45,000 to build up list of customers and their preferences. The list was completed on 1st March X8 and expected to be useful life of 5 years. No, customer list or customer data not to be capitalized. Customer list or customer data is not to be capitalized. It's like an internally generated goodwill. You have studied this statement: internally generated goodwill cannot be capitalized. And you know why it cannot be capitalized? Why internally generated goodwill cannot be capitalized? Although it's an asset, but we never capitalize it. Why? Because initially the asset is recorded at cost. Intangible assets are recorded at cost, and you cannot calculate the cost of internally generated goodwill. The efforts which you do, like you receive late night call of your student, you are replying to your customer, you are saying greetings to your customer. So it's a lot of efforts, and you cannot measure the cost of each and every efforts. So that's why internally generated goodwill cannot be capitalized. And same is the case with these customer list and all. So it is clearly written in IS 38 that customer list cannot be capitalized, so it will not be capitalized. Now 150,000 to acquire a technology on 1st July X8. It was expected to be used by Mizzle for 10 years. Now see, now that this last technology, this is your intangible asset, but it has a life of 10 years. It has a life of 10 years, so it will be depreciated. So first two intangible asset will not be depreciated, directly capitalized. So let's add it up. 330, then we have 12,000, and then we have 45,000 is not an asset. 150,000, but it will be depreciated. 150,000 will be depreciated. So 150,000 is the asset. Wait, depreciation is divided by 10 years. It's going to be 15,000 per annum, and we bought it on July. The year end is 31st October. Let me count: July, August, September and October, 4 months, into 4 upon 12. So 15,000 into 4 upon 12 is how much? 5,000. It's going to be 5,000. So 15 minus 5 is 145. 15 minus 5 is 145,000. 15,000 minus 5,000 is 145,000. See, this is the depreciation. So 150 minus 5, 145. So these are the three assets will go in the SOFP at the year end. See, I did not depreciate the first two assets. I did not depreciate the first two assets. I just depreciated the third one. So it will be okay. This will be 487,000. Giving you some time to read it. Please take care. See the question. You can see. So that's the end of today's class. I would recommend you to must solve the mock. Please try these questions also yourself. This is the extra help. I would recommend you to first try these questions yourself. It is you who has to perform in the exam. So try to build this skill to solve question yourself. Okay. Even if you do 4-5 wrong out of 14-15 question, if you're doing 5 wrong, it's okay. In this way, you will come in the rhythm. Okay. So that's the end of this lecture. And if you like it, do comment it and share with your friends. Thank you and take care.